Good afternoon, and thanks for joining us for today's webinar. It may be legal, but is it ethical? My name is Mike Hoffner. I'm the managing partner here at McKonly and Asbury, and joining me today is Janice Snyder. She's one of my partners and the director of our audit and assurance services. For those of you that haven't had the opportunity to get to know McKonly and Asbury in the past, let me just take a minute to give you a picture of our firm. McKonly and Asbury is an accounting and business advisory services firm with offices in Camp Hill, Lancaster, and Bloomsburg, Pennsylvania. We provide a range of traditional accounting, consulting, and tax services to organizations across a variety of industries that you can see on your screen. And we also provide a number of niche services such as cybersecurity, fraud training and examinations, merger and acquisition support, business valuation, strategic planning, and the list goes on. Simply put, we've got an assembled team of just amazing professionals who are ready to help you achieve your goals and to help you thrive. So we encourage you to visit our website to learn more about who we are and what we do. If you've joined us on past webinars, welcome back. If you haven't, please keep an eye on our blog for information on other topics that will be forthcoming on keeping you updated on what's going on around us. Keep an eye on our website on past presentations and things that you can continue to learn and share in the knowledge that we're trying to provide to our business community. Finally, before we get started, if you have any questions for us during the presentation, please submit them through the built-in questions function on the webinar control panel, and we will do our best to answer them during or after the webinar. If we don't have time at the end, it all depends on how much Janice and I talk. We'll make sure that as there are pointed questions that we can help with, we will answer you directly. For those that are looking to obtain CPE credit for the webinar today, keep in mind that, as always, there will be 3 polling questions throughout the presentation, and we will need to have answers to all 3 of those questions for you to get your CPE certificate via email, and that will come a few weeks after the webinar is complete. So with that, I think we should get started with a very simple first polling question. And for those who have joined Janice and I on previous ethics webinars, you'll know that we ask something similar to this most years, particularly in odd-numbered years. For those that are based in Pennsylvania, you'll know this is a reporting year. So we have the simple question. Are you joining this webinar because it's a reporting year and you always need your ethics CPE when we get to late October of a reporting year? Or is it because you couldn't wait to learn more about this topic? And of course, you have both A and B or neither A nor B. So everybody on our webinar today should have an answer for this particular question. So we'll just leave this open for another minute. And I am certainly hopeful that most of our listeners today will lean, of course, if I can guide you towards it. Is it ethical, Janice, for me to suggest that they answer B to make you and I feel better about what we're about to do?
Well, that would be great, Mike, but I think they can decide for themselves. But hopefully it's A and B. That's the answer I would like to see.
Lord willing. So we just closed the webinar down. Thank you all for, or not the webinar, we didn't close that down. We closed the polling question down. So it looks like, sadly, very few of you were dying to hear more about this particular topic as your sole reason, but we're okay with that because most of you also need the credits, and that's what we're here for, to make sure that you both get those and learn a little something and think about how to process some of these dilemmas in a case study based conversation on the difference between legality and ethical behavior. So with that, I think we jump right into what we're going to talk about today. And our agenda is, as I said, it's very simple. It's a case-based discussion, case study-based discussion on thinking through ethics versus legal, and there's a lot of things that we could get into in that area, and we could talk about things that have nothing to do with the accounting world, have nothing to do with making decisions in a role of a staff accountant or a controller or a CFO or a board member. We could talk about all sorts of things that are in the news every day about legal versus ethical, but we chose 3 very clear, we think, very clear case studies to talk about this decision tree in hopes that through talking about either mistakes others made or inattention to detail that others exhibited, maybe we'll get this audience thinking a little bit more about that difference between following the law and doing what is right. So that's what we're going to go through. And at the end, we'll talk at a real high level about a framework you can use to think through some of these dilemmas. Little bit of a spoiler alert, it's going to seem fairly obvious when we talk about it. But Just a thought process that we'll give you to go through as you try and find that perfect spot on that Venn diagram that you see on your screen, where it checks both boxes of it is the right decision in accordance with the laws and regulations, and it's also the right decision in terms of your ethical framework. So with that, Janice, I'm going to turn it over to you to get started on our first case study, which is about an example many of us lived, but many on the webinar may have just read in some of their business school thesis reviews. So Janice, take it away.
Great, thanks, Mike. It's great to have everyone here this afternoon. And we're going to start with remembering Enron. So I know Enron, gosh, it's been over 20 years. Why are we still talking about this? Well, I know for me personally, I joined this profession, I'll date myself a little here, in 1999, and this has shaped so many accounting rules, so many lessons learned. We're going to focus on one of them today with fair value accounting, but it really is a perfect example of things that were legal, but that were certainly not ethical. So when we look back to Enron, and we're back in the year 2000, they were the largest energy trader and supplier. They were one of the most admired and most innovative companies in the world. Other companies were trying to emulate things that Enron were doing. They were considered brilliant. They were geniuses at their accounting, at their structuring, at their special purpose entities. We're not going to talk about those much today, but they were trading at $90 a share at their peak. And Enron was flying high, as we say here. So what happened to Enron? So we had the perfect storm going on here, as we say. You got deregulation of the energy industry, and that allowed companies to gamble on future energy prices and what was going to happen there. You also had the dot-com bubble going on with some unfathomable values of some internet-based company stocks. We just saw things we had never seen before, allowing investors and regulators to just accept crazy swings and huge spikes in share prices and said, oh yeah, this is what the market is doing, and sure, that makes sense, and I'm benefiting from this. So then you have this bubble burst with a recession in 2000, and it contributes to these huge losses kind of happening at Enron and these wild swings. But there's one thing in particular I want to focus on today, is the accounting policy change that Enron made. They transitioned from historical cost accounting to a mark-to-market method of accounting. This was an SEC-approved method, but it allowed them to bring so much judgment into their financial statements. As an auditor, I don't like the judgment and the subjectivity of these things. I tend to like black and white rules a little bit more, but this was really one of the first major openings that gave companies this subjectivity to say, hey, you know, we can change our numbers and tweak them a little bit here, and we can take a look at what that means. So as they moved to the fair value accounting, you know, numbers started to change significantly. They have all these energy-related contracts that were outstanding, other types of derivative contracts, and a whole lot of things on their books and records being marked to market. At the same time, they had a whole lot of debt and other genius structuring, we would have called it at the time, through special purpose entities that moved a lot of those liabilities off of the books and records that would be reporting publicly, and that was affecting their share price. So by the end of 2000 alone, unrealized trading gains accounted for more than half of the company's $1.4 billion reported pre-tax profit. Like we said, unfathomable. But the market was getting used to some of these wild and crazy swings, and it really is what's going on here. So we'll continue with this story. So as we move into 2001, we see a little bit of a timeline here. So in August of 2001, you start to see Enron collapsing. You said the CEO mysteriously resigns. You know, he says, I have personal reasons, I'm stepping down. Was that valid, or did he know something was kind of amiss? You see the stock value dropping by over 50%, very dramatic, more of those wild swings that started to become commonplace. By October of 2001, Enron changes their pension plan administrators, and the employees are no longer allowed to sell their Enron shares. So as things are tanking and things are going down very rapidly in their stock price, employees get kind of trapped into holding these shares. the SEC then says, hey, I'm going to launch an investigation into Enron and look at some of this off balance sheet is what I would call it today. But back then they were a little more creative and called it special purpose vehicles, or we call it special purpose entities. And what are they hiding in these other, this was all legal. This was all things that were permitted under the accounting rules with some very creative structuring. The same time in October, the Arthur Andersen, I think this is really where Arthur Andersen went awry. Their legal team instructed the audit team to destroy all of their Enron files, except the most basic things. As an auditor, that would lead me to believe someone at Andersen knew something was amiss and was not right, because there are all kinds of rules about how long we need to keep our documentation, and we certainly do that. And then they had to go back and restate their earnings and go through this multi-year 1997 to 2000, and approximately 600 million in losses were recorded when they restated all these previous years, and 600 million in debt came onto the balance sheet. So you saw debt go up by these crazy amounts. I see Mike shaking his head, but some of us have lived this, and look, we remember this, and I'm sure several people on the webinar today do as well. So by December of 2001, the stock, remember, $90 per share high, is now trading at 26 cents a share. The market did not like all of these restatements and all of this quote off balance sheet debt. And then Enron ultimately files for Chapter 11. In January, they were suspended from the New York Stock Exchange, and in June, Arthur Andersen was convicted of obstructing justice. And those of us that were closer to that or know what was happening, this instance alone pretty much collapsed one of your large accounting firms at the time. So, and we never really got into the big five because mergers were happening, and we went right from big six to big four in terms of those large accounting firms. All right, so there's
our Andersen alumni. Sorry, our Andersen alumni who might be on the call would like me to, I'm sure, point out at this stage that the conviction was overturned. So, just to be clear.
Thank you, Mike. I did stop the timeline in our history lesson at 20 years ago. So, thank you, Mike. So who was the mastermind kind of behind this? So Andrew Fastow was the CFO of Enron. And we have a quote here about, I said they changed to the fair value accounting that got them to take huge write-ups on their books and records and huge increases. And we talk here about the mark-to-market or fair value accounting, that instead of using the historical cost method, when they switched to this, they got to recast old deals and recognize these items, these losses, as future profits. And Andrew's quoted here, fair value accounting is a good example of where ethics come into play, as it provides you with all these gray areas and allows for creative flexibility. So that's where Andrew was, but let's look at Andrew's timeline compared to the Enron timeline. So I did get to see Andrew present in the past. I find it fascinating. I always love what he has to say, so we're going to have a number of his quotes. But in 1999, CFO Magazine gave Andrew the CFO Excellence Award in the category of Capital Structure Management. He was revered for his financial wizardry. So he turned a sleeping natural gas pipeline company into a blazing energy firm. And at its height, you see there, Enron was the 7th largest company in America with a market capitalization of $35 billion, which is why their collapse was so significant. It affected so many investors and so many people. But you just start with those top 2 bullet points. He's CFO of the year. He's doing amazing things, and so many people want to know that. Financial wizardry. We just talked about that. So in 2001, Enron became the biggest accounting scandal in American history. And it turned out that his financial wizardry was more smoke and mirrors designed to mask Enron's true financial performance. So the company filed for bankruptcy on December 2nd, 2001, putting thousands of individuals out of work, and shareholders lost billions. So Andrew here as the CFO, he went through investigations, ultimately convicted of 78 counts of fraud, for his central role in developing the off-balance sheet special purpose vehicles that led to the company's collapse. He entered into a plea agreement here, forfeited his net worth of $24 million, served his prison sentence, and he comes out, and now he does a lot of public speaking in order to share his story with a lot of people about where it kind of went wrong in his thought process. He even believed for many years, but I didn't do anything wrong because I followed the rules. So he was a shrewd manipulator of those rules. And did a great job. So here's where we talk about Andrew and his legal fraud. So in our conversations, and this was an interview that was done in 2019, so I got to look back as Andrew was reflecting on all the things that had happened, and everything that he did was approved by their accountants, their auditors, management, attorneys, and their accounting firms. So how is it possible to have all these smart people approve these deals and end up committing the greatest fraud in corporate history? That was still the question that Andrew had. So Andrew is quick to point out, and we can still reflect on this, that if you look at everything that ENRON did, it was legal. It followed US GAAP and SEC rules. There's even stories he has that when they would have a deal and they would bring it to the boardroom, they'd bring it to the accounting team, they'd bring it to the auditors, and they would say, hey, this isn't going to get the accounting answer you want, or this isn't going to be recorded in the way that you want it to come out. They would go back and rework the deal so that the deal would meet all of these rules, would meet all the rules, and would be properly structured to support the accounting that would ultimately come from that. So they followed US GAAP, they followed SEC regulations. Everything was approved by both their internal audit team as well as their external auditors. It was approved by attorneys and bankers sitting in their boardroom, and it was also approved by their board of directors. So just taking a moment to pause on that, we did all these things, everyone's on board, everyone's agreeing, maybe a little bit of groupthink here. Maybe they couldn't see a way around it, but restructuring deals to get the answer that they wanted, to get the accounting that they wanted. And so the ultimate question of this entire webinar is, it may be legal, but was it ethical? So clearly the courts and his 78 counts of fraud concluded that it was not. And this was really Andrew and Enron's downfall. So Andrew, when I saw him speak a little while ago, he said, when I was initially charged, I still thought I was not guilty because I had followed the rules. Even made the comment in that dialogue that he said, I'm glad the judge, when he was sentencing me, didn't talk to me too much because I still would have proclaimed my innocence and that I had done nothing wrong. It took him a very long time to understand how he was manipulating the numbers and how he was manipulating those rules. So I'm actually going to give us an example. I changed years and changed numbers to drive this point home. But this is a commodity valuation example. It actually ties into some of the accounting rules. And this is going to be, when I advance to the next slide, not quite yet, our next polling question. But if a company has 1 million barrels of oil, January 1st, 2020 value was $94 a barrel. The 2020 first of the month average pricing is now $98 a barrel. And the 2020 12-month average pricing is $84 a barrel. And by December 31st, 2020, let's say oil was trading at $53 a barrel. Obviously, I've made this up. This does not tie to what actually happened to the oil market in 2020. But I created this example where we had really high prices at the beginning of the year, and we watched them decline throughout the year. So the question for us here is, what is the value of this? This would be inventory on their books. What is the value of this inventory at 12/31/2020? So I'm going to advance that, and we can bring up the next polling question. So Mike, I know my gut on this, and I actually went when I saw this with Enron and did a lot of research on what these rules are and how they work and of what would be the right answer. But you want to share what your gut might be on this, Mike?
Well, so I have the gift of knowing what the right answer is, Janice, since I got to see the slides ahead of time that you put together. But Honestly, where we sit, right, and I don't want to influence those that are answering it as part of their CPE process, but when we talk about what a balance sheet should look like, we always talk in context of historical cost accounting at the date, right? What's the date of the balance sheet? And so when I look at this and I say, well, if I just, taking away the fact that I kind of know where you're going with this, I look at, well, the value of inventory should be whatever its value or price is on the day that we value it. So I think my gut would be, just thinking through that way, that I would have to choose D, right?
Mm-hmm.
And a lot of people think the way I think, which is heartwarming.
They certainly would, and that is according to lower of cost or market or net realizable value for inventory where we are now. Even if you're under fair value accounting rules, most people would conclude that the value of that inventory and that oil is $53 million. So I happen to agree with the majority of our participants answering this question. But I'm going to point out why that's wrong here. So the company has 1 million barrels of oil, and the value of the inventory, according to Rule 410 of Regulation SX, according to the SEC, is $98 million. And that's because I'm not going to read the two rules down there. You can certainly read them as we're looking at this, but you have to go back and look at first of the month pricing and average that first of the month value so everyone can close their books on time and not wait for the 12/31/2020 value. They had to use the first of the month average pricing. And this is literally what the rule does say. I went and checked this and said, this can't be right. I am not an expert at energies futures and energies trading. But these are the actual rules that I've provided you with right here. And so you can see a huge difference in a company reporting that inventory at $53 million versus the one that's reporting it at $98 million. Now, if we step a little further into that and say, what if Enron did record it at the $53 million? Well, first of all, no one else in the industry would be recording it at that because they're all going to follow the rules. It just so happens that Enron was so large, it hit them much harder, but some of the other companies were impacted as well. If they didn't follow this rule, their auditors would at a minimum have to modify their opinion, or at least maybe just have an adverse opinion depending on the materiality, to say, I can't actually opine because you are not following these rules. So there would have been a number of steps, a number of red flags, a number of issues if they didn't follow the rules as they were written. So that's where Andrew is going. I follow the rules. And then this was an example in Enron, and the courts clearly have decided that it was not appropriate to just follow the rules. Ugh, as an auditor, I don't really like that. Do you like that, Mike?
I do not.
Makes me a little uncomfortable. It's where we like to stand behind our rules, and our job is literally to make sure that companies follow the rules. And Enron was a clear example that the company should not have been following those rules. So here is Andrew's last quote. There are people who look at the rules and find ways to structure around them. The more complex the rules, the more opportunities. And we saw that in this commodities example and the valuation, and we see that throughout this case with Enron. I'll repeat again, everything they did was legal. It was approved by everyone. It's not like things were hidden. It's not like things were kept off to the side. It's not like they were deliberately trying to mislead everyone, and they were ultimately following the rules. And I think that's a very tough spot to be in our profession, but we are called to be ethical and to make sure we are following the professional code of conduct, and we are staying in line with those items. And this does point out that sometimes following those ethics rules and following our code of conduct would mean perhaps we are not always following the rules. So, any other comments on that, Mike, before I turn it over to you for our second case study?
No additional comments. I think I'm actually, honestly, Janice, surprised that you got through that volume of information on Enron, which could fill a 400-page book, and managed to talk about it that quickly. So yeah, we can move on to the next one.
Okay, yeah, we can certainly talk about Enron all day, but I chose one issue from Enron, and that was the fair value accounting. So Mike, it's your turn.
Great. So yeah, and I think this is, you make a good point. Each of these case studies, particularly the first and second one, we absolutely could talk for probably an entire hour on each if we really went into the nuances and the details of what transpired beyond just the one example we picked out, the one case study component. But I want to shift gears and talk about another gray area here as we talk about this idea of what's legal versus what's ethical and where do they overlap and what's the right thing to do. And we're going to talk about just a different view. We're going to talk a little bit about Equifax. The Enron example was one of probably dozens, if not scores, that we could have discussed a selection of what would be a valid accounting policy being used to manipulate earnings in a very favorable way. We could have talked about case studies like where a discount rate on an actuarial valuation was adjusted just enough to swing the outcome to meet an analyst's expectation. So it's not hard to move a discount rate by a small amount to have a meaningful impact that might meet an earnings target or trigger a management bonus. And I think both Janice and I could give numerous examples where that could be done and very easily justified within what the rules would say and what the benchmarks would say. We could have touched on an example where an input on a lease was changed by a small amount to make sure. Now, yes, I'm talking current old lease rules, not new lease rules for those that are going to think to yourself, but it's changing. But how many times have we seen where a lease was adjusted by just a small amount to make sure that it stayed off the balance sheet as an operating lease instead of triggering one of the criteria to become a capital lease? And that, I think, was one of the problems with the old leasing rule, is that it was very easy to do and you could get the answer you wanted. Absolutely legal, but when your motives are designed to achieve an outcome and not necessarily designed just to do what's right, this is where we get into that gray area of legal versus ethical. So there's a lot of examples where an average reader of a financial statement could get two very different pictures of a balance sheet or an obligation or a transaction through a really minor input change. All legal, but what's the rationale behind it, and how do we, as not just as external auditors, but how do we in industry and how do we on boards make sure that those decisions we're making are pure of motive, even when we can easily justify the legality and likely appropriateness of them. So, but instead of talking about more debits and credits, I want to shift gears in this example, this case study, to talk a little bit more about inattention to detail and lack of action on what is a known weakness. So we've chosen to talk about the Equifax data breach. There's probably a lot of instances where we could cover this particular scenario, but the public nature of this particular failure, the involvement of the federal government, some of the nuances behind it, and some things, frankly, we won't get into in the interest of time today, they make this a good story. They make it a good one to think about and to learn from. So on the surface, when I finish talking about Equifax in a couple of minutes, you'll probably look at your screen, you'll look at the slide, and you'll look through that slide to me, and you'll say, Mike, this is really obvious. Why'd you pick this for a webinar? And so I'll answer that now before I get into the details. The answer is yes, I believe it's a good case study, but I believe it's only a good case study if it gets you as the listener thinking about potential things in your infrastructure that, if left unattended, could result in an issue that could harm your customers, could harm your employees, could harm your shareholders. And then you step back and ask yourself, am I doing everything I can to be aware of these weaknesses? And am I doing everything I can to remediate these weaknesses? Now, you and I may disagree on whether that bridges into an ethical issue. I tend to think it does, and I'll talk about that as I wrap up this particular case study. But if I get you thinking about some of those instances, then I believe the case study served its purpose under this title. It may be legal, but is it ethical? So let's talk about the basic facts on Equifax. And I'm not going to get into all of them. This, again, much like Enron, right? There are numerous aspects to this that I think we could talk about. I'm going to focus on the how it happened. I'm not going to focus on what the Equifax leadership team did when they became aware of it. That's a whole nother ethical case discussion that we're not going to spend time on today. So what happened? Simply said, and much of this comes straight from the House Oversight Committee's report after they investigated this. Simply said, Equifax's security practices and policies were subpar. The systems that they used were old and out of date. And at the end of the day, after the analysis, the House Oversight Committee in their report concluded very simply, had Equifax bothered to implement very basic security measures like patching known vulnerable systems, they could very well likely have presented this massive data breach. 150 million people plus, their information was compromised, sensitive information, and it would have taken simple aspects of security to make it happen. So again, how do we get into ethical conversations here? The question is, what did we do with known information? So without going into the minutiae of the issue, you can look that up if you're interested. A quick Google search will give you lots of information on what happened in Equifax. The major issue that occurred that allowed the hacker into Equifax's system was a known vulnerability in an open source web server, and not only a known vulnerability in the market or in the industry, but a known vulnerability that the Department of Homeland Security had issued a warning about months earlier. Let me repeat that. It was a known vulnerability that Homeland Security had published a warning to the markets about. Equifax, in my opinion, this is my opinion, had no argument for saying that this was an unknown risk. Yet they failed to do the patch. And we're not going to dig into the why, because a lot of that falls on how they defended themselves versus what the prosecution might have said. But beyond that, we didn't patch a known vulnerability that there have been public warnings about. Beyond that, the device that was used to monitor the network traffic associated with that vulnerable server had been inactive for 19 months. Why was it inactive for 19 months? There was an expired security certificate. When they realized this, it took them 2 months to update the security certificate, and immediately upon that update, they noticed suspicious network traffic, very quickly found out what was going on. Now, there are multiple other layers around this. There are issues with whether the data was or wasn't encrypted. Sneak preview, it wasn't. There is issues around how they might have or should they have been paying different types or more attention to the security certificate. Well, yeah, they should have. There's issues around this, I believe, decades-old open source web server. Was it the right one? Should they have moved on? Take all those other things out of the picture and think about simply a known vulnerability that Homeland Security had warned about on a product you use, and the one tool that would have allowed you to catch it, catch a breach, hadn't been updated, or the security certificate had not been upgraded in 19 months. Those two facts alone are enough to make you step back and say, where were they? How did they fall asleep at the wheel? Again, is it an ethical issue or not? You and I may disagree on that. I think it is. A lot of other facts, as I said, that we could go into, but let's keep it simple and focus on those two. A company that held personal data in volumes that, in their opinion or their measurement, the data they held was 1,200 times the volume of data held by the Library of Congress, right? That's a lot of information, and I would wager virtually everybody on this call was part of or exposed in this breach. They held that much data, and they failed to patch a known vulnerability they had been warned about and failed to keep a tool upgraded that would have identified it. So was this failure to act and upgrade their product illegal? I don't know that, and we'll talk about in a minute what's changing in that space, but I don't know that there was any law that said you have to maintain X security environment, right? Was it unethical? Again, I'll leave that to you, but in my opinion, I would argue very clearly that inattention to detail and protecting sensitive data that you have been entrusted with is easily, in my mind, viewed as a violation of the public trust. Therefore, it is an ethical issue in relation to the tone at the top of the organization that was trusted with that data. So we'll talk at the end about this framework, right? But it really is this process of stepping back and thinking outside of the accounting space, outside of the debits and credits. What do I use to value my inventory? What do I use to determine the calculation of a liability that's actuarially determined? Let's think about, from an organizational perspective, what am I entrusted with, and am I doing the right things to make sure that I'm taking care of the data that I've been entrusted with? Again, illegal? Probably not. unethical, I would lean that way, and it comes from tone at the top. So something to keep in mind. I mentioned we would talk about it briefly. Is this where are things going on the legality side? Because I think it's important for you all to hear and understand that. So federal and state efforts will continue in the area and are continuing in the area of legislating some of the things that went wrong in this case study. So an example, if any of you on the call work in the defense industrial sector, you should be aware of the Cybersecurity Maturity Model Certification Process, or CMMC. The federal government is in the process of mandating that all contractors, and not just prime contractors, secondary and tertiary, all the way down the food chain, contractors that serve up into the federal defense industrial base will be required to have work done over their cybersecurity framework. It's something that if you work in that space and you're not familiar with that, go check out our website. We have written a couple of articles in this space to make sure you understand it. It's an area that we're particularly attuned to with some of the work that we do in the cybersecurity space. So pay attention to that and go check it out if you haven't yet. But understand that as legislation changes, and perhaps we start to see some of these things that we see things that EQUIFAX may be ignored over this period become things that legally they'd have to pay attention to. That, look, I get that. That's great that we're moving that direction, but at the root of it, regardless of legislation and the sound practices on cybersecurity and data protection, an appropriate ethical consideration of what you've been entrusted with, these things should be done whether they are legislated or not. So it's that idea at the bottom of the slide, I just jotted in, right, legal framework versus sound business practice versus ethical considerations. That middle of the Venn diagram where legal and ethical align, 99.99% of the time will also align with sound business practices. Harvard Review, I believe it was there, just recently published statistics that ethical companies, and Janice and I have talked about these stats on previous ethics webinars, companies that are demonstrated to have a high degree of ethics correlate to a high degree of profitability and a high degree of public trust. So these all go together as sound business practices to help you drive profit. So that's all I'm going to say to wrap up the EQUIFAX case study. Again, there's a lot more to it. If you want to do a little Googling and reading, it's very interesting if you haven't dug into it in the past. But with that, I want to turn it over, Janice, anything to add on that, and otherwise jump into your next case study.
I just think it's a great reminder, Mike, for everyone listening that failure to act. I mean, we're all busy, right? I'm sure they had nothing else to do in those 2 months when they didn't do those upgrades and when they didn't take the actions that they probably should have. That failure to act can also be an unethical behavior. So legal through this point, yes, it was. That may change in the future, and laws and regulations do change all the time, but the failure to act can also make something unethical. And that we can all have excuses on our failure to act from time to time. So I'm sure no one is sitting around doing nothing and just so excited that this is what they have to do this afternoon. So, but thanks for an engaging example, Mike, and I'm going to move us on. So the next two slides are what we're calling case study number 3, but they're actually two slightly different things, but they get back to the same theme of what are you approving? And I said before, I've been in this profession a little over 20 years, and these are personal things that I've seen. One is public, one is not. So I'm not going to share specific names or companies or anything of that nature. But the first one I wanted to take a look at is an organization where the CFO was approving invoices. And if I sit back and look at this, there was an equipment vendor that was submitting invoices for equipment that they claimed they had installed, that they had provided to the organization. The company had good controls in place. You know, they were doing 3-way matches where you're matching purchase orders with the invoices and someone is approving them. And, you know, they're getting the receipts that those goods came in the door. They're going, okay, we're great. The CFO is then going in and saying, yes, this was a valid purchase. I approve it for payment. So there's a lot of things going on really well at this organization. However, if you look at the third bullet point there, the vendor that was providing this equipment, the vendor that was coming in to install this equipment, And the vendor that was providing these invoices was not doing their job. They weren't installing new equipment. They're saying they did, but they didn't. The equipment was old. The equipment was not being updated. And so they were committing an illegal act. So I want to be clear on that. There was a vendor committing an illegal act. However, the role of the CFO is what I wanted to look at here. So the CFO, we're busy. I've said it before. The CFO is like, I don't understand the nuances of all of this equipment. I don't know if they installed this tiny little piece here. I don't really know what that means. And so the CFO really didn't maybe ask enough questions, didn't do enough of a deep dive to truly understand what they were approving. And they didn't really know. I mean, they had every reason to believe that those charges were legitimate. There was a lot of fraudulent and illegal paperwork that was submitted to them. And this organization had good controls and processes in place. But sometimes when we're running too fast and we're not being really diligent, things were getting approved that should not have been. These were not valid expenses. And with a few more questions and a little bit of digging deeper, it's likely the controls would have worked and this would not have happened. So this organization in particular lost over $200,000 over 3 years with equipment that they purchased that was never delivered, not installed or not fully installed or not updated. And again, we're looking at the interplay here of someone was committing an illegal act. That is clear. That is not the, it may be legal. No, that vendor's actions were illegal. But I want you to look at this from the lens of the CFO. Was the CFO behaving in an ethical manner when they were signing and approving these invoices? Did they truly know and understand? I know some people in our organization know I'm pretty difficult and pretty challenging with that. Wait, I need time to review this. You don't just get my signature. What does this mean? I usually have questions. I go back, maybe to some individuals' dismay. But I'm not going to sign and approve that unless I really do understand what I'm signing. And in some cases, it takes me longer than maybe it should take someone. But I want to make sure that I'm fulfilling my responsibilities and behaving in an ethical manner when I am signing off and I'm approving something that I truly believe that it is appropriate. And I don't think the CFO thought anything they were doing was inappropriate. I'm certain they had all the documentation. Well, I know they did. They just really didn't understand what it was that they were approving. So this is kind of part two. This is a completely different organization, but it's still along the line of what are you approving? So this sort of happened, an office manager, and I'm just going to pause and do this a little bit in reverse. This was an organization that wasn't much more than $10 million a year in revenue, and they had $6 million stolen over 5 years. So I just wanted to start with that because that is absolutely astonishing. And that theft, that true theft, that was prosecuted, this is public, like that theft, that is illegal. Clearly, there was jail time that was done, and most of that money was not recovered. So clearly, illegal behavior was happening. But I'm going to look at this again from the side of the CEO. Do you know what you're approving? Do you know the way you're handling these things? So you had an office manager in an organization that was coming forward to the CEO and saying, hey, here's all the original invoices. I'm giving you all of them. And here's the list of all the checks I'm going to cut. And there's 30 invoices here. And the list is a list of 30 checks. We're in a hurry. I didn't cut the checks yet. Can you sign these checks? And then everything will match up after the fact. And part of the reason this happened is because the CEO traveled a lot. The CEO was not in a lot. So the CEO just went down the list and said, I got 30 valid invoices, did a thorough review of every single one, reviewed that checklist, signed all the checks, and the checks were printed after the signature. So for anyone on the call, that should raise a flag that is a problem. But they were being efficient. They were being effective. The CEO was like, let's just get this done. So then the office manager would go print the actual checks that were signed, manually signed by the CEO. And then the CEO would come back later and match the total of the checks, say there were 30 checks went out. They could do all this virtually. And they would say, yep, that's good. And then the CEO would review the bank reconciliations on a monthly basis. So how did this happen? Well, first, we shouldn't be signing blank checks. We don't ultimately know who they're going to be made out to. But what was the scheme there? So the office manager was duplicate paying invoices. So you come in 1 month and here's an invoice and it's a rather large one. And they would say, oh, okay, I'm going to submit that in the pile of checks, in the pile of invoices. It's a legitimate invoice. I'm going to put it on the check listing. And then they were getting it signed. And then they were actually printing the check to their friend, Joe Smith over here. So the check goes out, the check comes back, it's got the wrong vendor name on it. But, so there's the fraud, the money is gone. So how does the actual invoice get paid? Well, the invoice was getting paid the same one as it would get submitted maybe a month later or 5 or 6 weeks later with a different check run. And it would get a valid invoice submitted for approval. Yet again, maybe someone should say, why is this date 30 days ago? But a lot of the invoices at this point, once you start this and you get away with it 1 week, and then you get away with 2 invoices the next week, they're not all like that. But then you say, hey, our costs are rising. These things we're purchasing cost more. That all made sense. That's what was happening. And then they said, oh, we're holding cash a little bit. We're not making money. Cash is tight. We're paying our invoices a little bit later. And so you start to see that happening as these get extended further and further. So the first payment was fraud, and the second payment was the real payment. I always, as the auditor, go, how do you catch that? Well, the way you catch it is usually the person gets too greedy and things just spiral. There's not enough cash. The organization starts to lose money. $6 million is an enormous amount of money. But also catching that, I'm like, you could catch it by looking at the checks that came back. Like, do they all match? Now, I don't know any organization that is actually doing that. That is probably not very practical. I also know, I was at a seminar earlier this week, there's a lot of banks that have positive pay and ways you can match this. This was several years ago. I've been doing this for 20 years. But I want to make sure that we stop and say, was the CEO behaving in an ethical manner? No CEO, because they're traveling or as a shortcut or anything like that, should be signing blank checks. Like, I'm pretty sure you don't sign any blank checks. Is that a fair statement?
Indeed.
He is nodding his head yes. And while this is a very simple example, it comes back to the question that I have is, what are you approving? So I know that I serve on some boards. I love that role and be able to do community service. But sometimes, man, a day or two before the board meeting, I'm getting 100 pages. And I'm like, wow. So I have to say, gosh, do I have time to read 100 pages? The answer, of course, is always yes. But in reality, I go through and say, gosh, in most cases, I do have time to read 100 pages. But sometimes I have to go to what we're voting on and make sure I know that information inside and out, because I should not be voting on an item I'm not completely comfortable with when I'm sitting in those boardrooms. So that comes back to approval as well. I was in a board meeting just the other week, and an individual in the meeting said, you know what, I've asked some questions. I think I still have some other questions. I see that everyone else is comfortable. I'm going to abstain from this vote. And I was like, that is fantastic. That's what we should all be doing when we're not confident in what we are approving. So I certainly saw that as a great example of an ethical behavior. So just something, both of these case studies, there were individuals committing illegal acts, no doubt, large amounts of money, $200,000 and $6 million. Either one of those is significant to any organization. But it does make me step back and say, what was the ethical or unethical behavior that allowed this to happen? Not every fraud, not every illegal act happens because somebody did something wrong. But in these cases, I could point back and say people were approving things they did not understand, or signing off on things that were not complete, and it created that opportunity. I think our fraud team would love me pointing out the opportunity here of the fraud triangle. The unethical behavior created an opportunity for these thefts to occur. So anything you want to add on that, Mike?
No, I think we'll roll it into sort of our wrap up here on a decision framework, because I do think the first step that I have on that really dovetails nicely with your third example there, your third case study. So when we think about a decision-making framework around finding that spot where we've achieved both legal and ethical, I said at the beginning, and I will repeat now, nothing that is in front of you on the slide should be life-changing and earth-shattering as you think through this process. It is simple, it is straightforward, and that's intentional because while these decisions are not simple, the process to get to the right answer should be. So step one, I think this ties in, Janice, to your comment about understanding what you're reviewing and what you're signing. That idea of fully identifying and understanding the issues. So if you are in a position where you're on a board, as Janice said, or you are a approver of a transaction or a signer of checks, you need to make sure that you have adequate time and visibility to understand what you're executing. So if you're in that board seat and 6 hours before a 4-hour board meeting or 2 hours before you get that 100-page packet, abstaining from a vote is the right answer. But at the same time, then you need to push back and you need to simply say, I don't have all the facts I need, and more simply said, you didn't give me enough time. And if you want me to make a decision like this, you need to give me time to understand the facts because I need to identify and understand the issue. The other thing that comes to mind on this first point is thinking, again, beyond the accounting and beyond the reporting. We are here, most of us, to get CPE credit. That means most of us are certified public accountants who have a reporting obligation to take this course, which also means most of us think in context of how an accountant would think, which is ethics and legality in terms of making accounting decisions. But think about the EQUIFAX aspect. Think about the community organizations you serve on. Think about things outside of just debits and credits and understand what you're getting into. So the second step, look, it's simple, right? Is it or is it not legal? I understand that laws and regulations have a tremendous amount of gray in them. When you live in the gray area, your process for determining the correct ethical decision becomes even more valuable. But try and stay out of the gray area and understand that there is a right answer, even if the law is written to allow for multiple right answers. Third step is to consider your ethical and moral implications. Obviously, if we have to decide whether it's ethical, this is sort of a clear and obvious step. I think it goes without saying that there's no universally correct answer. There is no answer that is going to be exactly the same, that Janice and I would come to precisely the same answer through precisely the same process on a gray issue that involves ethics. I'd like to think she and I would land on virtually the same answer, but it would be different. There's no right answer in this space. But you have to think about who's impacted, how you get there, what would they think of the decision you made. We've all likely heard that question of, would you want this to be on the front page of your local paper or the front page of the Wall Street Journal? I've heard it said otherwise, which, you know, as much as there's things that I wouldn't want to be on the front page of my local paper, I've heard it said, and this one resonates more with me, would I want to have to explain to my mom why I made the decision I made? And if I don't want to have to talk through with my mom and justify a decision, then I probably am making the wrong decision. So think about those things. And then finally, communicate and document. At the end of the day, if you make a decision that falls in some form or some area of the gray, you have to think about those that need to support you and have your back if that decision gets questioned. So document why you made the decision you made, your thought process, but more importantly, make sure you share that decision-making process with the board or your entire management team. If you are an executive and you know that you're living in a gray area, but you are completely confident that if everybody knew the facts you knew, they'd make the same decision and it's the right decision, then you need to step back and make sure you've communicated that so that they are not, your board is not blindsided, your management team's not blindsided, and they feel part of the decision-making process. So there is no written AICPA framework for ethical behavior. There is an AICPA framework for ethics in the profession, and we've presented on that at previous webinars, and I am sure at some point we'll blow the dust off those slides and present it again for another reporting year. But these are just things for you to think through. So Janice, before we wrap up, anything to add to the discussion?
I just think, Mike, that, I mean, there's a lot we could add, but we're coming to the end and we have one more polling question. I always like in the auditing world, you can go through all these decisions and all these processes, but as auditors, we say, if we didn't document it, you complete that, Mike, it didn't happen.
Didn't get done.
So we say that all the time. I don't know if everyone else should live by that, but as you're making these ethical decisions, clearly it needs to be legal, that needs to be there. But we also, I see a comment coming in here that someone who has a lot of experience as a certified internal auditor, certified fraud examiner, saying that everyone believes they need to be ethical, but they hear a lot of, but I don't have time, followed by, I trust the people giving this to me. And I always think most people don't let someone who has cheated them or lied to them or something in the past continue to work with them or to give them documents to sign. You feel like, I would never trust that. So I think there is a presumption that we do trust the people we're working with, and we do need to, but it makes it all the more important to question and verify.
Yeah, absolutely. So we're going to close with our final polling question, which is just for our information as we build future ethics webinars. This is something Janice and I actually enjoy working towards, and we enjoy the annual opportunity to come up with an interesting way to get you your credits. So our question for you simply is, which of these 4 things was most valuable? Which discussion impacted your thought process the most or got you thinking about things in a way that perhaps you hadn't been thinking about them? So I think as you process that, it will help us figure out when we sit down next spring to say, hey, we've got an ethics webinar in October. How do we make it interesting? Because quite frankly, reviewing the AICPA Code of Professional Conduct section by section doesn't really do it for Janice and I. But if that's what you want to see, we'll do it. But at the end of the day, we find that these more discussion-based presentations work better on our side.
Well, I hope
So
we at
with
least,
that, go ahead, Janice. You were about to say something?
I was just going to say, I hope we at least gave everyone some things to think about that differentiating line, because things may be legal, but are they ethical? But still, we go back. I look at these poll results, Mike, where we go back 20 years. I still love to talk about ENRON. I had followed the rules. I think it is a great, great example of that. Any other comments there, Mike?
What I take away from that, Janice, is that everybody liked the 2 things you talked about and nobody liked the 2 things I talked about. So on that note, we're going to close things out with our final commentary, which is simply a thank you. Thank you for joining us for the webinar. We appreciate the time that you spent with us. We appreciate the attentiveness and the questions that we will make sure we answer since we're out of time here. If you do have other questions, our contact information is on the screen there. Please feel free to reach out to either of us, and we'll be happy to circle back and assist you in talking through either ethical or legal frameworks, or help you find the right person who maybe can get into some of those nuances that are more legal based that we can't. So we look forward to hearing from you on that. Final thing is that a recording of today's presentation will be available on our website and through our social media sites in just a few days. For those of you who requested CPE and answered the polling questions, those certificates will be sent out within the next 2 weeks. So you can look for those, and if you don't see it, please reach out and we'll make sure you get them. So thank you again. We appreciate you joining us. Enjoy the rest of your day and have a wonderful afternoon.
Thank you. Bye.